Hi everyone, and welcome to Learning Objective 1-5. In this learning objective, we are going to explain the factors that encourage high quality financial reporting. So when we talk about financial reporting quality, what we're referring to is how closely our financial statements as a company and the related notes that we disclose to those financial statements, right? Because a financial reporting includes giving people outside of the company copies of financial statements, the balance sheet, the income statement, the statement of cash flows, the statement of shareholders' equity, giving people outside of the company copies of those statements. And then what accompanies those statements are notes to the financial statements. And those notes give you additional detail about the numbers that you see in the statements. All right, so financial reporting is this process. We go through preparing the statements, preparing the notes, and all of the other related disclosures, and giving that information to people outside of the company. So there is this term, financial reporting quality, which, as you might guess, refers to how good these statements are. How good is the balance sheet? How good is the income statement? How good are the footnotes and disclosures that are accompanying these financial statements? How do we even measure how good they are? How do we measure quality? Well, when we talk about financial reporting quality, what we mean is we want the financial statements prepared by a company to match economic reality as best as possible, right? So that is what we mean by quality. If the statements closely match what happened in the real world, then we have high quality financial reports. And there are different ways that we could test whether or not that is true. There have been academic studies that look at the relationship between current period net income, for example, and how well that current period net income predicts future net income, or how well current period revenue recorded in the income statement predicts future revenue, right? And those are kind of tests of measuring how useful, what the quality of the financial reporting is. Okay, so we want, overall, what we want is our financial statements and the related disclosures. Overall, we want them to match reality as closely as possible. Okay, within the confines of accounting standards. So how do we ensure that this happens? Well, what could go wrong? What are some risks? Why would the statements not match reality? Well, think about it. You're the president of a company, or you're the CEO of a company, the chief executive officer, right? And we're talking about our pizza shop. And somebody else owns the pizza shop, and they've hired you to run the business for them because they don't want to be involved in the day-to-day. That's too much work. So they hire you to manage the business. You're the CEO of the pizza shop. And your job is to run the business, keep track of the transactions, prepare financial statements. And as an incentive for you to do a good job as the CEO, the owner says, we'll give you a bonus if you hit a profitability target of X, right? If you have profit for the year of $10,000, let's say, then we will give you a 10% bonus. Okay, we'll take your salary, multiply it by 10%. You'll get additional bonus as a result of doing well, managing the business well. So if you are the CEO and you are managing the business and you know that you're going to get a bonus if your profit is $10,000, what's your incentive? Well, your incentive is to make the financial statements look fantastic, because if you make the financial statements look fantastic, you're going to get a bonus. All right, so you might do things, you might choose how you record accounting transactions in a way that boosts profitability, because if you do that, then you'll get a bonus. All right, so how do we get around this problem? We have, on the one hand, we want the owner of the company, the shareholders of the company, they want truthful financial statements that match economic reality. And then on the other hand, we have the managers of the company, the CEO. They're trying to maximize their own bonus. So we have two groups of people that have different incentives. So how do we get them on the same page so that we get high quality financial reports? Well, the solution to this problem is that we hire somebody they're not the owner of the company, they're not a manager of the company, they're not an employee of the company, because these are the two groups that are in tension here, right? The CEO wants to maximize his or her bonus. The owner wants to maximize his or her investment. They have two different incentives. How do we deal with this? Well, we bring in a third person that has neither of those incentives, and they're completely independent. They're not an owner. They're not an employee. There's no skin in the game for them. There's no reason why they would want the outcome to be X versus Y. And so you bring in somebody impartial. They come in and they look at the financial statements and they give an opinion, their own opinion, about the quality of those statements. They say the financial statements fairly represent, in all material respects, the results of operations, blah, 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 blah. Right? That's what the auditor says. The auditor's final product in the process is to say, we have looked at this company's financial statements, and you, the owner of this pizza place, you can trust that these financial statements fairly represent what happened in the real world. So we call this independent third party the auditor. So auditors formally, so the formal definition here is auditors are independent third parties. So they're not an employee of the company, they're not an investor in the company, that provide an opinion regarding whether the company's financial statements comply with generally accepted accounting principles. All right. Now, to be an auditor, to be able to sign an audit opinion, to give that opinion, you have to be a certified public accountant, a CPA. So a CPA is an individual licensed by a state to provide audit services. And because of their role in providing an opinion and making a representation about the financial statements, what is vitally important for auditors is that they maintain independence. They ensure that they're not they're not an owner of the company. They ensure that they don't have a personal relationship with the managers of the company, so that there's no conflict of interest. And ethics is vitally important in the accounting profession for these very reasons. Now, back in the early 2000s, there were some accounting scandals that resulted in significant changes in the audit profession. Now, I won't talk in detail about these, but there were some cases of fraud that occurred at companies like Enron, Tyco, Adelphia, and also WorldCom. And that's just a few. There were several others that all kind of happened around the same time in the early 2000s. And as a result of this, Congress passed the Sarbanes-Oxley Act. So the Sarbanes-Oxley Act basically overhauled the entire audit profession back in the early 2000s. Okay? So that is the background here on auditing and how auditing improves, or it's meant to improve, financial reporting quality. All right, well, this has been a discussion of Learning Objective 1-5. I hope this video has been helpful. Thanks for watching. I'll see you real soon. Take care.